Tech has been driving this market for some time. Can it keep going?
I mean, the extraordinary thing that defines these tech mega caps is that they get better as they get bigger. And so you typically think about economies of scale or diseconomies of scale and companies get more efficient. But the larger Facebook gets, the larger Apple gets, the larger Amazon gets, et cetera, the more data they have, the more they can refine the product. And I think that's the main reason why people have been so stunned by the extent of this rally, because we're just not used to seeing companies get better and more competitive as they get larger. And so, look, can they get going? I don't know. If I knew, I might not be here. But I do think that there are conditions of their growth that have just really surprised people. And in a way, you sort of people have been very foolish calling the top of all these.
So, Stephanie, has the network effect just changed business as we know it? Changed the economy as we know it?
We know it's turned economics on its head because you have these increasing returns to scale. You are supposed to have, diminishing returns at some point, and it just obviously hasn't worked that way. I guess in the context of the stock market, we should remember, what we were saying at the start of the program, which is these are extraordinarily loose conditions. So investors are being pushed into buying stocks. So then if you're already in that position where there's a great incentive to find stocks that you want to buy, I think that tech is sort of benefiting from the fact that they have delivered the earnings by and large. This isn't just about re-rating. This has also been about, I think, the biggest companies have raised their earnings by about 40% over the last 2 years. We've got, they are doing incredibly well in terms of margins. So I think it's not just, there's a combination of, there's something specific about tech that gets better as it gets bigger, but also that how they look relative to this other environment in such a loose, an environment where people really are being encouraged to get into stocks.
So they're making more money, I understand. Why doesn't it become overvalued? Because traditionally markets go too far and they overvalue and there's a correction.
Well, who's to say that they're not overvalued right now?
Well,
this is like the problem.
Well, I think there's two things that really speak to Stephanie's point, and I think one of the defining images of everything, but particularly the market these days, is this idea of the barbell. So you invest in the fastest growing companies in the world, Amazon's, Facebook, Shopify's, and so on, and you buy German bunds and U.S. Treasuries yielding 1.5% or 2%. No one wants that middle. No one wants the companies and that's just like the sort of safe GDP-linked growth that you might get from some industrial. So you buy the safest stuff and you buy the riskiest stuff. And I think that's kind of, you're pushed into these companies that have their own secular growth stories, their own compelling things, because the overall economy itself is kind of mediocre.
And that is this sort of bizarre thing where we just, all these years, we're talking about the wall of worry and the unloved rally, and yet you see the market going to these all-time highs. And it is the case that you have this deep pessimism and concern that you see embedded in now negative real yields again. The Treasury has gone lower and lower over the last year, Treasury yields. And at the same time, this sort of optimism and mania about the tech stocks. The two are coexisting in this barbell.
The other thing, and you asked about overvaluation, and maybe they're overvalued or not, but most investors will say overvaluation is not in and of itself enough to get a sell-off. Something has to catalyze it, and the thing that usually catalyzes a sell-off is a recession. But you usually don't get a recession until you get overheating in the economy, and what we've really had for 10 years is this sort of it's okay growth. Not recession growth, but nothing that's really going to make central banks want to slam on the brakes. So it's kind of like, it's a cliche, but kind of this Goldilocks environment where it's just not strong enough to get that recessionary response.
Well, this is a fascinating point. It's a different kind of barbell. It's sort of like get really high asset values, but pretty modest growth. That normally you say, that doesn't sound so healthy, but maybe it sustains.
And coexisting with these Treasury yields that you really wouldn't normally say were healthy. I mean, what is going to get real yields back up? It goes back to the conversation we had right at the start about inflation. But as things stand, we've been flirting this week with the inverted yield curve again. The fact that the long-term interest rates are getting shorter than the short ones.
So what does this mean for Ben Graham and Warren Buffett? Value investing just gone? I mean, I thought that was the way to go. Is that just written out of the Lamb's Book of Life?
I mean, it is interesting how much money will have been lost. I mean, a few years before I came to Bloomberg, I was at JP Morgan, and every year there was that debate. Surely this will be the year for value. And value has never been cheaper. It's never been more attractive. And arguably, you look at the whole of Europe and say Europe is looking very value stocks right now. But again and again, the growth comes through. And I think that is as a feature of this curious environment, economic environment. Until that changes, I think investors will be very nervous of changing their strategy.
But Joe, this has ramifications well beyond the investing class.
Yeah.
This has ramifications for employment, for capital formation, things like that. Because if you end up with it all being intellectual property and a relatively few people having huge capital, by the way, they don't need to invest the capital. It's not like they need to build plants and buy equipment and things like that.
Right.
It really changes the economy.
Oh, there's so many ways that it's changing and going to change the economy. I mean, one thing that doesn't get that much discussed but as you said it exactly, is the sort of the inequality that's a result of, like, one person goes to work out of college for Facebook and another person goes to work out of college for FedEx or something, and the person who went to work for Facebook is going to make a lot more money. The degree to which one's own fortunes are tied to the success of the firm, and if that firm is done phenomenally well, all kinds of interesting ramifications that I don't think we're used to seeing in previous regimes.
So, Stephanie, the perception, at least, is that we haven't seen the same kind of tech phenomenon in Europe as we have in the United States. Has that led to something of a divergence in the two economies, or at least in the two marketplaces?
You've certainly seen it in the markets, and that's what's interesting, is when you actually go into the composition of the difference between the European stock performance and the US performance, actually it's not so much that their individual sectors have behaved so differently, it's just the tech sector is so much smaller. And it is also that European financials have tended to do worse. But that was just a big part of the market that's missing in most of those European markets, and it has made a difference. And of course, it's something that a lot of European policymakers have a lot of angst about. They feel that whenever there is dynamism in these tech sectors, but any sensible German tech person wants to get bought out and immediately head off to San Francisco.
And so the French say, how about a digital tax?
Yeah, right. I guess that's one way to
It's just a coincidence it goes
back
against U.S. companies.
Right. But no, to your point exactly, it has confounded a lot of people in the markets because they're like, oh, surely this is the year that international stocks are going to outperform the U.S. stocks, or EM stocks look so much cheaper. But in the end, what they're making is a stealth tech call, and they don't even realize it, because all they're really saying is that non-tech stocks are going to outperform just because so much of the tech value is on U.S. indices.